Hi, this is Alan Gassman. I have Chris Rowe here. This is the CPA Academy 11 a.m. Eastern Standard Time presentation. This is the early bird show. So on your screen, you probably see the login for estateview.link. This is a free web-based software program that you can use during the presentation if you like. What you do is put in your browser, not a search, but your browser at the top of the screen, estateview.link, estateview.link. Click on that, and then EstateView will come up, and then you will, oh, hold on, start broadcast. Okay, so this is Alan Gassman. I'm with Chris Rowe. So to get on EstateView, which is not necessary but helpful for the presentation, you might enjoy it, put in your browser EstateView, estateview.link, L-I-N-K, that's the browser at the top. And then your email address is test@test.com. That's all smaller caps, T-E-S-T, at test.com. And then your secret password that you should tell nobody is TEST, all small caps, and then the software will come up. It looks like I was going to look something like this when it comes up, and then we'll be clicking on calculators and various other things, and you could watch this video and do the calculator at the same time. Let me also mention before I forget that if you watch this on YouTube, there's a way that you can, on the bottom left-hand side, hit settings and then increase the visibility. And you can even increase and slow down the speed if you like, if you're watching this on YouTube. Okay, so now it's 11 o'clock and we will begin. Welcome to part 3 of managing a family's complex wealth structure. I'm Alan Gassman, I'm your moderator, and your presenter today is Chris Rowe, who is an extremely bright and experienced and passionate financial and estate tax planner. And if you've come in through CPA Academy, you will get credit. You just have to answer 4 polling questions. And I'm going to do the first polling question right now, just to get it out of the way. And Joe, are you ready for the first polling question? So the first polling question is, come see us at the Heckerling Institute on January 8th for that week in Orlando. And the polling question is this: which of the following will you attend? A, the Heckerling Institute on Estate Planning in Orlando, January 8th through the 12th. B, my Rollins College presentation in Winter Park, Florida on January 25th on hot topics in planning and creditor protection planning and charitable planning. C, the AICPA Edge program in Las Vegas, November 3rd through 6th. Or D, 2 or more of the above. And I guess E would be none of the above, or I'm not sure what to do if you're not going to any one of those. Maybe that means you have to go to one of those, or we flubbed it up. But whatever you answer, you will get credit. And sorry to confuse you on the first question. Joe, how many answers do we have?
We're at 86%.
All right, good. So time to go back to the presentation, talk a little bit more here. If you came in through our website and you are a Florida licensed lawyer, then you have my condolences, but I am also, and we will get 1 hour of credit with the Florida Bar. Just let me know if you need the credit and we will send you the information, or you can click on the slide where you see it there. So very, very important. This is a 1 hour presentation. After the hour, I'll still keep going. Chris may still keep going. It'll be fun. It'll be educational, but you're only getting credit for 1 hour. So the reason I say that is because we always get people at the end of the second hour that go, oh, I'm really angry. You didn't tell me. Well, that means you weren't listening. So please listen. If you have questions, we will answer your questions today. Click on the inverted question thing, type in your question. It's best if you also type in the answer so that we know the answer, but if you don't type in the answer, I will handle it if it's easy and Chris will handle it if it's difficult. A couple of articles in the last Thursday report. If you don't get the Thursday report, let us know. We'll send it. Lower interest rates are coming next year, according to the Fed, but I still think you should lock in the interest rate we have in an installment sale, and we will talk about why. One reason is if you lock in an interest rate right now about 4.5% and the rates go down, in my opinion, you can just lower the rate when the rates go down. I don't think that's a gift. Even if it is a gift, when you run the numbers, you can come out better. The second thing is if you're doing installment sales and you've been using Wandery clauses, I would rather use a king clause. And there's reasons for that. If you just go to the Thursday report or ask us for a copy, we will be glad to tell you about it. And of course, happy holidays to everyone. And I'm just going to go ahead and get done with the second polling question, so you don't have to ask me about polling questions as much. On January 25th, I am going to give a talk at Rollins College. There's going to be a walking tour if you get there early of the most beautiful college in the country, according to many ratings. And then we'll be talking about dynamic planning and charitable planning. It's absolutely free. You'll get 2 hours of CLE time, free food, and even a free book on charitable giving. Are you going? That is polling question number 2. Or would you like to go? If you'd like to go, we would love to have you. I will contribute $1 towards your round trip airfare and lodging. So A, yes, B, no, or C, please provide more information. And that's like, would you like to go out with me? A, yes, B, no, or C, let me think about it, which really means no. Joe, how are we doing here on attendees? Are they sharp? Are they ready?
84% right now.
Okay. 84%. We need 90% before we can move to the next thing and then open up this program. Can I go ahead and change presenters now, Joe? So I am now going to change the presenter to our wonderful star, Christopher Rowe. Click yes. Chris should have control. Normally I just give my wife control over everything. Today I'm Chris control. So Chris, I see your screen. You can open it up. You've got a state view there.
We're all good?
We're good. Take it away.
Thanks. So today, for the next hour, this is part 3 of the series of managing a family's complex wealth structure. I want to start with what it takes to spend a few minutes on what it takes to manage a family's wealth structure. Over the last couple meetings and seminars, we talked about designing it, building it, going through and analyzing the initial structure and coming up with a plan or roadmap in order to build their structure. But once you have it built, it's kind of like your house. Once you build your house, well, you don't just forget about it. You have to continue to do maintenance and improvement and check on things on a given year. Same way with your finances. So, I want to start with the first few minutes of just talking about what it looks like to manage a family's wealth in a given year, and then go through 4, 5, 6 examples using a state view of things that we may recommend for a client in a given year that they do, because a client's situation is constantly changing. So opportunities that don't exist currently will pop up in the future. For instance, they might say, hey, look, we decided we want to sell our business, or our kids were 20 when we started, now they're 35 and they're able to take on the business that we have, and they're going to move up and become part of the management team. So we'd like to consider maybe transferring some interest to them. Or, hey, we're receiving a big pot of money. We'd like to maybe think about some charitable intent that we really didn't have in the past because we didn't have enough assets to give away. So those are some of the things we'll talk about in the next hour. Let's hop in and saying, look, what do we do on an annual basis to deal with a client's complex wealth structure? And it's much like your family physician. You go to the family physician, you go for your annual physical, he or she asks you the same questions every year. And you're like, well, this is kind of boring. I do the same thing. They take my blood, listen to my vitals, go through a series of checklists and questions. And what's the goal? The goal is not to make you bored and be like, wow, this is boring. No, the goal is to make sure that the physician has asked you all the proper questions in case you actually answer yes to one of them and not no, 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 no. You know, how you feel? Good, right? He wants to know, no, I'm having a problem. So he or she wants to maintain and wants to know if a problem pops up. So looking at it from our financial perspective, what do we normally do with a client? Number one, we review their business if they have one. We sit down, we ask them about it, we ask them how the business is, what the cash flow is, etc. Number two, we talk about their cash flow, where their money's coming in, how much is going out, what they're spending. Again, just and then comparing it to last year, we're just making our checks to make sure we're not missing something in there. Insurances, property and casualty, and life insurance. Is it still life insurance still relevant to them? Is it still meeting their goals? How are they funding it? Is it properly funded? Is it performing as we expect? Property and casualty, do they have adequate coverage? Have they bought something and forgot to insure it? Have we moved houses or assets in trust, but yet we didn't name the trust as an insured on the policy? We look at their debts. Liabilities, opportunities to refinance, of course, not in the higher markets, but or higher interest rate markets, but what kind of debts out there? Are they getting payments? What's their estate plan? What are all the trusts? What are the provisions? Who are the fiduciaries? Who are the trustees? Are they still good? You know, Cousin Eddie is my trustee. Well, I haven't talked to Cousin Eddie in the last 10 years. Geez, I forgot to change him on there. So we want to make sure that all the fiduciaries who serve in the estate plan are still relevant. We want to make sure they're competent to serve. And, you know, a lot of people pass a lot of money in trust and then they name their friends and relatives, and their friends and relatives, while they're well-meaning and probably have the family's best interest at heart, they may not be competent to handle the amount of assets that are going in these trusts. We also look at tax planning for their trust, tax planning for their business, tax planning for them. We talk about family governance. How are the kids? What are we doing with respect to the kids? Lastly, charity. Who are they supporting? If they have a foundation, how's it operating? Or did we do our 5% required gifts, etc.? So as you could see, and I'll stop there with respect to the list, it's sort of like going to your doctor. Each year you sit down with the family and you go through everything they have, including their investments and how it's performing. Are there any investments that need to be changed? What are the tax ramifications of those? And as we do a sort of, we'll call it our annual physician check of their finances, again, what's the goal? We hope the goal is to be boring and everything's good. But occasionally we spot opportunities and life and things change. So you need to stay on top of them on an annual basis. And that really will drive us into, we'll call it some of these estate planning examples that we want to go over with clients, that clients have. As part of managing, right, it's interesting to do estate planning, right? And we could set up these great acronyms of trust called CLATS, CRUTS, you know, GRATS, SKINS, QPERTs, you name it. But setting them up is one thing. Alan does a great job at drafting the documents, getting things funded and set up. But over the years, most clients take it upon themselves to deal with the administration of these items. And that comes with managing. And they have a tendency, Alan, you could speak to this, right? They have a tendency to not manage them properly. In other words, I've been in situations where a client has done an installment sale and you ask if they paid the note payment. They go, no, I haven't got paid in 10 years. I mean, the note requires you be paid principal and interest every year. No, I don't care about that, right? Or they have a GRAT, but they don't pay the annual GRAT payment in time because they're trying to do it themselves because they have someone at the business that, you know, their secretary or executive assistant who's, she can handle that. She moves money around in my checking accounts. So it's very important when you put a plan in place, it's very important to manage it. And a lot of times, a lot of our estate planning techniques that we use are very good, right? I mean, a GRAT is right in the Internal Revenue Code. So how does the IRS argue a GRAT? Well, sometimes they may argue valuation, but generally it's improper administration, right? I mean, if you don't administer it right, if you don't pay the payments on time, it doesn't work. So it's very important that not only you build a good plan for a family, but that you make sure that that plan is managed and administered going forward in order to make sure it's successful in the end. So let's start, you know, I want to go through some real hypothetical client examples, but on this webinar, things that each one of you who participate can take away. And so recently I had a person, it was really a tax client of mine, who came to me and said that there are, you know, her advisors had recommended she has concentrated stock, about 5 million, and said, hey, look, I want to sell my concentrated stock. I'm no longer with the company, but my advisors recommended to me I contribute $500,000 to a donor advised fund because I'm charitably inclined, and B, I wrap that around with a conversion of my regular IRA to a Roth for 500,000. And so that should work. And I said, well, number one, if you contribute appreciated stock to a donor advised fund, you only get a 30% deduction. So if all of your income was a $500,000 Roth conversion, you only get to take $150,000 worth of charitable deduction against it. So is that really what you want to do? Number two, you said you wanted to diversify the whole $5 million at some point, maybe not exactly today. So maybe there's another strategy. And so, and believe it or not, what I did, I came home from the meeting and I pulled up the state view and I said, wow, you know, let me run. What happens if they do a CROT, right? What happens if she does a CROT? Her husband is actually younger than she is. So, so I pulled this up and I said,
Hey, Chris, let me,
yep, go.
before you go for it, I want to mention a couple things.
Sure.
For one, we get a lot of people who say, hey, the screen is too small. Well, at the top middle of where you see Chris's computer screen, you see the 4 horizontal lines. If you click on that, if you left click on that with your mouse, you can move the screen up and make our pictures disappear. And I know a lot of people want to make my picture disappear, so that will make your screen larger. The second thing I want to mention is, because we have a lot of people on here who may not know what a CRUT is, may not know what a donor advised fund is. So a CRUT stands for Charitable Remainder Unitrust, and you put assets into it and you get a little tax deduction and you get payments over a series of years. And then at the end, it goes to charity, which could be your favorite charity or your family foundation. So that's a CRUT. And when you put appreciated assets into a CRUT, you don't pay income tax when they get sold until you get your payments back out. So you could defer income tax for many years.
Right.
And then the 30% limitation is if I put 500,000 of appreciated stock into a donor advised fund, or 500,000 of appreciated capital gains real estate into a private operating foundation, I get a $500,000 deduction, but it's only countable up to 30% of my adjusted gross income. So then it carries forward for up to 5 years. So Chris, sorry to interrupt you, but I have a big ego. I want something.
Well, no, thank you. But that's really the key on this. What you said about the 30% deduction is the fact that if a client is going to contribute $500,000 of appreciated assets to a donor advised fund, basically their income to get the full deduction in a given year, their income needs to be, call it, 1.5 million or so. So where this particular client's income probably is with the $500,000 of Roth conversion is only going to sit around $600,000 to $700,000. Number one. Number two, the wife's goal here was to basically take her appreciated assets and diversify them. right? So I said, well, look, if you, over the years, if you contribute that money to a donor advised fund, you're basically giving it away. So you're depleting your estate, but you're not getting anything back. So what I did was I basically said, well, hypothetically, what if they contributed $2 million of assets to a charitable remainder trust? Okay. And then what I did was, and I inputted, she's sick, the younger of the two spouses, which is the husband, is 60. So I said, well, let's do it for the younger of the two. And let's assume a 6% growth rate on the assets. I put in 2 million, and I wanted to maximize my payout rate right here, 13%. And the reason I wanted to maximize it, because I was trying to get to this number. So I was figuring out my payout rate and how much assets I want to put into this trust so that I could get a $200,000 deduction, which is about 30% of their $700,000 in income they'll have with the $500,000 of Roth. So if they just simply did a $500,000 to a donor advised fund, the money would be gone. In this particular case, they were able to diversify 2 million of appreciated assets. As Alan said, every time they get a payment, and here's your payment column, every time they get one of these payments, they're going to have to pay tax. And the tax is going to be, the first thing that comes out of this trust is ordinary income. Earned interest, ordinary dividends will first come out, then qualified dividends, and then capital gains. So effectively, they get installment sale treatment for the remainder of their life on the sale of $2 million of appreciated assets. So in other words, it allows them to, number one, sell 2 million of appreciated assets, diversify, get the $200,000 charitable deduction they wanted this year. Next, they get payments over their lifetime. So they haven't disinherited themselves in favor of charity, and they get payments. And in the end, when, depending on when they're going to die, let's just say she dies at age 90, $215,000 is left in the trust that goes into their donor advised fund. So in the end, they achieve several goals: diversification of their assets, paying tax over many years, which allows the money to stay in trust and earn money instead of paying the US government. They achieved their tax deduction they wanted. They got to do the Roth, the conversion that they wanted, offset by their charitable deduction. And and they basically got this money out of their estate also, right? So should husband die early, more money goes to charity and they don't pay estate tax on it. But there's a little catch. And the catch is, wife says, well, wait a second. What if husband dies? What if he dies early? What if he dies in 5 years? And now, all of a sudden, let's look in the 5th year. Boy, there's $1.4 million of assets still in this charitable remainder trust, and that's going off to our donor advised fund. Well, what if I need that to retire on? Like, what if I need that to live on? Right? And most people, regardless of how much money they have a tendency not to like to give it up, right? They like this control. So if using estate view, one of the things I had mentioned to the couple was, okay, is there a point, the question is there a point in time when, to the spouse, you're okay with the fact that if your husband dies, that some of the money left in this trust, you wouldn't need it to retire? And maybe that's 10 or 15 years out. So what I did was I went back and you do a quick life insurance estimator and you say, okay, I want to do it, and I'm not going to change the name, on a male. And, oh, sorry, he is 60 years old, right? And you got 20-year term, and assume he's preferred. So it costs $5,000 a year for the next 20 years to basically say, regardless of what happens in that charitable remainder trust, if he dies in the next 20 years. Wife, you get $1 million. And she might say, well, how about $1.5 million? Well, it's $7,800. So I can get a tax deduction, get lifetime income, defer the capital gains on selling of appreciated assets, and guard against a premature death by buying term life insurance. And in our particular case, we don't even need 20-year term. We need about 15 because she's 68, so that puts her at 83. Do you think she needs an extra $1 million at age 83? No, not with the rest of their estate. So in our case, we would probably spend about $5,000 a year over the next 15 years to guard against a premature death. So let me go back to where I was. And Alan, any questions? Any thoughts?
Well, are you going to show us maybe a 20-year CRUT so she's guaranteed payments for 20 years? And then we should mention at least briefly that there's something called a flip NIM CRUT where you don't have to take the payments until the 20th year, basically, or you could take them as you want to take them.
Right. And I did, in this particular case, I illustrated the lifetime, but we can also illustrate a term of 20 years. So here's the illustration of the term of 20 years. Okay. And he's 60, so that's going to put him to 80. Our payout's going to go down a little bit from 11 to 10%. We still have the same charitable deduction, right? And again, we could back that up with life insurance over 10 years or 20 years. So if you look out 10 years, basically how these payments have worked, making the assumption of a 6% growth rate, in 10 years, there's $1.2 million going to charity if husband dies. So you could do a 10-year $1.2 million policy, or you could do a 15-year, $1 million policy, and I'm sure the person would be fine. And in 15 years, there's 900.
Well, I think with the 20-year CRUT, she would just continue to get the payments until the 20th year if he dies.
Right. Now,
well,
I didn't do a joint life expectancy 20-year. So I just did a single because he was younger, but you're correct, Alan, right? You could do a joint life 20-year where she continues to get the payments. That's one. If they didn't care about that, you could make cheap term life insurance to back it up. And I think the whole point was there's sort of multiple ways to attack this problem.
Yeah. Now, do you want to just show the audience that if you click duplicate on the top left-hand side in green, that now you're showing a second one, and then you can just change something on the second one and compare it to the first one.
Right. So if you wanted to say do the lifetime versus a 20-year, and you'll do the comparison. So the first one's a 20-year, right? And you could see the charitable deduction is the same and what the value is, but you notice the difference between a 20-year CRUT versus a lifetime CRUT is total payments go up about $400,000. And of course, the ending value goes down. And the ending value would be the value that goes to the charity at the end of a person's lifetime.
Yeah, so we're gonna improve the software next year by showing possible life insurance needs for each year and amount to charity versus amount to continue payment on death. So that you're coming up with great ideas for the software.
Right. And one other thing with respect to term life insurance, right? So let's assume this particular client decides to, it's just hypothetical, right? Hey, let's do $1.5 million for 20 years. Well, we don't need to keep the $1.5 million for the whole 20 years. At some point in time, we could reduce that face, which reduces the premium, because we could back down that life insurance for the years that we need it. So maybe there's only $1 million in the CRUT at some point in time, and both of them say, hey, look, there's $1 million in here. Let's take that $1.5 million policy and just cut it to $750, so we could save some money. We don't really need that total coverage. So there's some flexibility. And I think the reason I make that point for everyone on this call is that our presentation is called Managing the Client's Finances. That is ongoing management. These strategies generally aren't set it and forget it. You have to manage them, number one. Number two, someone each year has to calculate the payments and make sure they get paid. People forget to do that. So that needs to be done. So when these strategies get implemented for our clients, for Alan's clients, for my clients, right, we need to make sure that we're there each and every year to make sure the administration on these things happen.
So for those of you who may be more technically minded or want to learn more, on the left-hand side where you see in yellow 5.8%, I had forgotten when we were programming the software that you don't have to use the 75/20 rate to determine your payments and your percentages. You can use the highest of this month's rate and the previous 2 rates. So the second thing that you see here is the transfer date at the top is December 16, 2023. Well, there's a rule that a lot of people forget about, and that is you're going to have one payment in 2023 for just those 15 days. And when you calculate your minimum 10% remainder and your maximum 5% payment, you have to do them based upon that stub first short year and then a snub last year. Now, not all the software programs do this for you. Also, we have questions. What is the software? It's a proprietary software developed by my law firm. It's free. You can use it absolutely free until April 1st. And then on April 1st, we hope to start charging for it. But we would let you know before you start getting charged. Go to estateview.link in your browser, estateview.link. Click test. Your name is test@test.com. Password test, and then you can do this along with Chris. Chris, anything I missed there?
No, I think we covered it.
Yeah, I think it's wonderful when a client says to you, should I do a Roth conversion? And you say to the client, are you charitable? Then the answer is, are you going to give to charity to generate a deduction for the money that you're generating by the Roth conversion, by converting your regular IRA to the Roth IRA? And if so, should you use a charitable remainder trust? And if so, do you use a unitrust, which pays you a percentage of value each year, or do you use an annuity trust, which pays you an absolute amount each year? So even if the investments don't do well, you get that minimum payment for that number of.
Right. And I think it's really, when you look at managing the family's finances, right, it's just for you and I as a professional helping clients, it's about thinking outside the box, right? And asking the questions on an ongoing basis. Are you charitable? Are you just, I think initially when I met with them, they thought, well, this is easy. I give 500,000 to charity. I give 500,000 of a Roth conversion. We're good. Tax is zero. I think most people think that, right? It's a dollar for dollar offset. And basically I could do both and it's zero. And as I told the client, the Roth conversion is great, but you're also going to be in a low tax bracket going forward. So do you really need to think about, let's do all the Roth today? Maybe we spread it over 4 or 5 years. But the real problem, they are charitable, and the real problem was this concentrated stock. So we could do multiple CRUTs or CRATs or NIM CRUTs or whatever the acronym is, that is the ultimate strategy. But it's really about bringing advice and different perspectives to the client's situation to help them achieve better outcomes.
Yeah, and let's mention something that should be very obvious. If you're a CPA or you're a tax lawyer, you're giving clients this advice, get with somebody like Chris and make sure you're not missing something, because it's great to sit with a client and you think you know the best solution, but it's a good idea to brainstorm with other people and of course bring in the financial professionals. And in the charitable area, we need all the help we can get because it is so darn complicated. My biggest criticism of Internal Revenue Code on the charitable area is there's just way too many landmines. It's very complicated, but it works beautifully when you get it done right. So Chris, do you want to go to the next example?
Sure. And I'll make one last point on the charitable area and the Internal Revenue Code, right? You would think that the goal of government would be to have people be charitable, right? And it should be much simpler to benefit a charity than it really is. I agree with you, there's too many landmines. So let me run into the another example, and this is really just how we think about clients. There's an attorney who I happen to be talking to, and this attorney was going to get a large contingent fee, and it was going to be about 20 million, very charitably inclined. And over the years, he's basically given about 50% of his earnings and net worth to charity. He supports various charities on a given year. And his goal was, hey, when I get this big contingent fee, I don't want to pay tax on it, all of it, because I want to give 10 million to charity. And I said, wow, that's fine, but do you have like charities in mind, or are you looking to just give 10 million? And he says, no, I don't have any particular charities in mind, but I want it, since I'm going to have the income, I want to give 10 million and I want to explore some things. And of course, we talked about with 10 million, a family foundation or a donor advised fund and the benefits of each and the pros and cons, which is kind of outside the scope of our conversation today. But then I walked away from the meeting and thought about this and said, what if he did a charitable lead annuity trust? And Alan, you want to give a quick 2 seconds on what charitable lead annuity trusts are?
Yeah, charitable lead annuity trust is a statutory vehicle. It's right in the Internal Revenue Code. And it says that if I give my assets to a charitable lead annuity trust, the charitable lead annuity trust makes an annual fixed payment each year to a charity of my choice, which could be my family foundation. And what's left at the end of the CLAT term can pass to be held for my family at zero estate tax, because 99% of the charitable lead annuity trusts we do are called zeroed out. So I put $1 million into a CLAT. It's going to pay $8,944 a month to charity for 20 years. And then I'm not considered to have made a gift, because actuarially speaking, everything is expected to go to charity if the CLAT is earning the 75/20 rate. But if I do this right and I use discounts, then at the end of this term, there should be a lot there for my descendants. In addition, if I do the CLAT while I'm living, I can get an income tax deduction for what I put into the CLAT in year one, even though my children or others may benefit from it at the end. So that's called a lifetime CLAT. A lot of clients say, on my death, whatever it takes to completely avoid estate tax will go to the CLAT, make the minimum payments to charity needed to qualify for the charitable deduction, and then whatever's left at the end of that 15th or 20th year to the family, and there can be a lot left.
Right. So thanks, Alan. What I illustrated here was just a simple client. The client's age 70. He was going to make 20 million of a contingent fee, so he wanted to put half, or 10 million, into charitable foundation or donor advised fund. So on the flip side, I said, look, let's do a charitable lead annuity trust, and we'll put 10 million in. If you notice, the client gets income tax savings or a $10 million tax deduction. So he saves roughly 3.7 million of income tax in the highest tax bracket on day one. So he achieved his 20 million of earnings, $10 million deduction, an offset of 3.7 million of tax. So he achieved the tax savings he wanted. In this particular case, which you could change how you want it. So we could say, look, I want a level payment going out which means each year we have to pay $829,000 to charity. In this case, what we would do is set up a family foundation and pay it off to the client's foundation. Or we can do, which is my favorite because the little shark goes across the screen, the shark fin, which means, we pay minimum amount out to charity with a big chunk paid in the 20th year. And you can notice this illustrated value. This is the end value going to the client children, not the foundation. The foundation gets the payments every year. The client children get this sort of end illustrated value. Okay? So, and again, you could toggle the payments to see which may make sense. You could see here, if we pay the 829, we basically end up with 1.5 million. If we do the shark fin, we end up with 3.3 million for the benefit of the client's children. So if you sort of take a look at this over the next 20 years, which basically makes the client about 90 years old, his life expectancy is pretty healthy. So, he could get to 85 or 90. So during his lifetime, he will fund his family foundation with roughly $27 million. He will then roughly give his children $3 to $4 million estate tax free after 20 years. Number three, his children will be able to manage and run the foundation post his life and have 27 million of assets, which, they could take reasonable fees for managing it, reasonable salaries, et cetera, for managing it. So if you think about this strategy, it went from, hey, I want to just give 10 million away to a donor advised fund cash so that I can get the full deduction. And if he did that, it would be great, and he would benefit charity, and it would be fine for him. But on the flip side, what I did was I said, hey, look, how would you like to benefit charity? How would you like to set up a foundation? How would you like to probably give more money to charity than you were going to give anyways over time? And number three, benefit your two daughters and benefit them with money on the at the end, and also benefit them by allowing your legacy to continue on many years after you just gave away this $10 million. And they can continue to run a foundation with your legacy and receive some payments from that. And, in the end, the client's like, wow, that's a powerful strategy. So some other things to consider is this type of charitable lead trust needs to be a grantor trust so that the client can get the first year tax deduction. But that also means that going forward, any earnings in this trust, a grantor trust is basically considered an entity that's disregarded or it doesn't exist for tax purposes. The grantor of the trust pays the tax. So each year, this grantor has to pay the tax on any earnings in the trust. So that's a negative, it's sort of a drag, but it could be a positive to the extent that the grantor has an estate problem and is basically drawing down his estate by paying some tax on money that will go to children or charity. It's effectively a tax-free gift. One thing to consider when we talk about managing is, since the grantor has to pay tax, we need to consider how the assets in here are invested. Are we tax efficient? Do we use some structures that may defer some tax for many years? I was in the process of exploring, should some of this 10 million go into some life insurance that covers maybe grantor and his spouse, so that we know we kind of can get a sense of, if we want to kind of lock in our ending value, we can kind of almost guarantee over a period of time what our ending value is. And again, those are things I'm in the process of exploring. And I bring that up from the standpoint of simply, you should leave no stone unturned when you're thinking about this. A lot of times there's a lot of strategies and ideas we bring up. They may not work. They may not be palatable to the client, but they still should be brought up and explored. I'll stop there. Alan, any comments or anything else you want to add on this?
Yeah. First of all, fantastic presentation. Secondly, if the client says, well, I want it all to go to charity, well, would you rather have a $10 million tax deduction, or would you rather have $14,453,000 in tax deductions? Because you get 10 million when you put it in, and then if you get it back in 20 years, then you could go ahead and donate it again, donate what's coming out again. If you want it to come back to you, it would be better. If I wanted to make a $10 million gift, it's better to make a $10 million gift to a CLAT, which comes back to me after, or to a trust for my children that I'm considered the owner of. And then after that 20th year, pop that to charity. So that works.
Right.
Would you mind clicking duplicate there?
Sure.
So if you click duplicate, and then can you switch it from a shark fin CLAT to a 20% per year increase CLAT? Okay. So what I wanted to show here is, and then under first year annuity, which is green on the top, you want to just make 50,000 yellow and 117,000 yellow just by clicking on those numbers. If you click on the 50,000, that makes it yellow, that makes it yellow. So, the shark fin CLAT, we don't think the IRS is going to like it. So just a CLAT that increases the payments by 20% a year, your first year payment is going to be larger, but it's not a huge difference. It's just something that this allows you to illustrate. And then do you want to go to advanced, Chris, and show, let's go maybe click on duplicate again. Yep, and then click on duplicate. And then let's show if we put in a discounted asset. So, yeah.
Let's say we put in 10 million, but we discounted at 30%.
Yep. Okay, so now the annuity amount is less. The income tax savings is a little less, but the amount going to the remainder interest is now, look at that, 39% instead of 9% with that little discount. So, and one thing, by the way, I like this, and I'm sorry, I really like these two columns, because this shows you the present value of what's going to charity and the present value of the remainder interest. So even though you might say, hey, look at the far right, the kids are going to get 15 million in 20 years. Well, 15 million in 20 years isn't going to be that much money.
Right.
So it's still only 39%, but it's still a nice thing. People like the CLAT a lot. We've had a lot of good results with them. And another idea, Chris, is you could do a preferred common partnership and give the client the common interest and give the CLAT a preferred interest that will make the payments almost exactly. And then the client family pretty much knows that they're going to get all the excess and that the CLAT's going to get all of its payments. So those are all things to put together. On the top left-hand side, Chris, if you want to move it up just educationally, the CLAT also is a vehicle where you can use the best of the last three 75/20 rates, but this one it's best to go lowest. So you see there that it would automatically take you to the October rate of 5.4%. So we have 13 minutes here. Why don't you, if you want to give me control again, or actually, you don't have to give me control. You don't have to give me control. Let's just do the next polling question.
Sure.
Joe, are you awake? Wake up, Joe. Okay, the next polling question. If you'd like to give us feedback after using Estate View in exchange for a free book, if the answer is yes, please say yes. Oh, actually, wrong one. Does Estate View seem one, too complicated? Secondly, not complicated enough? Or third, like porridge, just right? And then while you're answering, I've had 3 or 4 people say, what is Estate View? Well, it's free till April. How do I get on it? Put the word Estate View, ESTATEVIEW .link in your browser, click return, For your name, put TEST at test.com, TEST.com. For your password, put in TEST, and then it's free, and we hope you use it a lot and give us guidance on how we can improve it. And Joe, what percentage are we at?
We're at 87.
87, good enough. Chris, what? Joe, let's go ahead and let's do the next polling question, which I think is polling question number 3, just to get these out of the way. Polling question number 3 is coming up. And then this is, would you like to give us feedback after using Estate View in exchange for a free book? And this can be any book that you see on our Amazon site. Yes, no, or I'll ask my beta fish. Now, we do not yet have a version for beta fish, but we'll definitely be thinking about how to do that. The thing is, the beta fish don't like the calculators because their little fins get sore when they use them. Okay, Joe, how are we doing?
87%.
87%, that's beautiful. Okay, we're back to Chris here. Chris, you've got 10 minutes to show us one more example, and then of course the perennial question, will you come back to show us the rest of your examples sometime soon?
Sure.
Excellent.
Let's do another quick example. Let's do a GRAT. A GRAT is a charitable remainder annuity trust. And generally, clients put in assets, and for a term, minimum of 2 years, could be longer. And over the term, they basically get paid back the asset value they put in plus an interest rate. So it's effectively like they're selling the assets to a GRAT, and they're getting paid back the amount they sell for plus interest. And whatever's left after the term, 2 years, 3 years, 4 years, whatever's left in this charitable remainder annuity trust goes on to their heirs. Some of the ways that I've seen these done, and Alan can speak to this, is sometimes when people generally are selling businesses, they work great. But a lot of times people go, well, I don't want to put in a lot of money because what if I need it? So one of the ways you would do it is you would set this up for the benefit of your spouse. So as long as you're not divorced, or she hasn't passed, or he hasn't passed, you know, the spouse will have access to the trust in the future after the payments are made. And so you basically have access to your asset, or access to your assets. Just a thought on that. But in this particular case, I'm going to flip over to advanced mode. What I did was a client has.
By the way, yeah, Chris, I'm going to just interrupt you.
Go ahead.
You've accidentally called it a charitable remainder annuity trust, but it's a grantor retained annuity trust, as you're well aware. But you've accidentally called it a charitable. It's not charitable, but all good.
It's charitable to the kids, is it not?
Right. And the classic example that you see across the top is that somebody age 60 puts $9 million into the GRAT and agrees to receive back $4,895,000 a year for 2 years, and whatever's left in the GRAT at the end of the second year is out of his estate, and there's been no gift made at all. So if the asset grows at 6%, then at the end of the second year, there's 143,000 in the GRAT, and there's no gift made, and that's out of the person's estate. Plus, the person's been able to pay the income tax on the GRAT income, as you see in red there under the income tax burn. So the estate tax plan savings just from the burn in the first 2 years are 28,000 coming out of the estate. So go ahead, Chris. Sorry to interrupt.
Well, and as Alan pointed out, no, thank you, Alan. But as Alan pointed out, putting 9 million in, getting a 6% growth rate, you basically have to pay back the grantor 5.8%. There's not much of a spread or an arbitrage there. So that only gives you about 143,000. But using the advanced calculator, I go down and say, okay, Well, actually, what if the client did 15 million?
You want to click duplicate first?
Oh, sorry. Yes, that's a good point. Sorry, Alan.
That's all right. That's what I'm here for, to get in the way.
Okay, we'll do that. Yes, let's duplicate and we'll make the change. So now let's say we put in the same 9 million of assets. As you can see, the two scenarios are exactly the same now. But let's assume the 9 million is a minority non-marketable business interest. And we decide to take a 30% discount. That is allowable. Now all of a sudden, look at the change just from the discount. So the client's going to receive back, instead of 4.8 every year, they're going to get 3.4, which leaves more money in the GRAT and more money in the remainder interest to go to the children. So it makes a big deal and a big difference just by taking that little bit of discount. So normally what you would want to do in GRATs is you would want to use business interest or some kind of discountable assets, so that it's almost, if the client lives the 2-year term, and the client must live the term or assets come back in their estate. If the client lives a 2-year term, you know from the discount you're going to make what we call the hurdle rate, or the 75/20 rate. Just by taking a 30% discount, you know if the client lives 2 years and we make the payments, there's going to be money left in this graph. Another strategy that I've used for other clients, and assuming they have plenty enough money, and this is something I believe, Alan, the software is going to illustrate in the future, is when the client receives back this, call it $6 million of assets, I would probably begin to do rolling grats. In other words, every 2 years, we take the annuity payment amounts the client gets and we throw them into a new grat. And sometimes they work, sometimes they don't. But it's a long-term strategy where the client's 60 years old, he has 20 or 30 years to live. So you would keep, every time an annuity payment's made, you would do a new grat. Every time an annuity payment's made, you would do a new grat. And a lot of times when you do this, it could encourage the client to do more. I think clients, at least in my experience, and Alan, you chime in on this, I think clients have a tendency, they like these strategies, but they have a tendency to be more conservative than they probably should be. In other words, I don't know if I want to do as much of the business as I should. I feel like I'm going to need the money. Even though you can prove to them, Mr. and Mrs. Client, you spend 700 grand a year, you're worth $80,000. I don't think giving away 20 grand is going to, or 20 million is going to change your lifestyle. But they go, how about 10? I think it's just the nature of all of us to want to keep control and make sure that we don't run out of assets that we spend our whole lifetime building. So Alan, your experience on that?
Well, I agree, but as you recall, or as you said, if you have a spouse, then the GRAT can be for the benefit of your spouse after the GRAT term, and it can be a floating spouse provision. If you divorce, it could be for the next spouse, and the GRAT could be in an asset protection jurisdiction like Nevada or South Dakota, and have trust protectors that allow the grantor to be added back in if his or her net worth ever go down precipitously. The GRAT is really good for high value estates because you don't have any real gift tax issue.
Right.
If you undervalue the asset and you were working in good faith, then there's no gift considered as made. It's just the payments back are larger. And
No.
Yep. Go ahead, Chris.
Oh, sorry, I didn't mean to interrupt, but when you said that and I think you just answered it, but what happens, let's say, what happens if the IRS challenges the valuation? How does the GRAT protect you from that IRS saying the valuation's higher versus maybe an installment sale or some other transaction?
Well, if the IRS is successful and I acted in good faith, then I just have to get more back out of the GRAT. So if the IRS, like look here, my annuity was 3,426,000 because I took a 30% discount. Well, the IRS may not like the idea that you're taking a 30% discount on an LLC that's paying off in 2 years.
Right.
So the worst case scenario here is that the GRAT is going to owe me the difference, an extra 1 million for a year. So the GRAT's going to have to give me 2,000,008.
Yeah, so let's say the IRS argues for 25%,
Right.
right?
You see the difference.
You see the difference.
Right. That's right.
But there's no gift tax implications.
There's no gift tax payable. There's
Right.
no gift
Where if you made a gift to your children and you took a discount, 30% discount, and the IRS says, no, it should be 20 or 25, now you have a gift tax implication.
That's right.
You don't get that back. Cool.
That's right. That's exactly
Okay.
right.
It's about the noon hour, so I'll stop right there with these examples. Hopefully, as I end, I just want to end with this, that, you know, managing a family's complex wealth, including our own, it's an ongoing endeavor, right? You need to constantly stay on top of it. You need to constantly question and look for opportunities and the risks that creep in, because our lives change. And so I don't think any of these strategies or really managing one's finances is ever a set it and forget it proposition.
Yeah. So let's go. So we're going to go forward. For those of you who would like to stick around with us, there is no continuing education credit going forward. And I don't know how long you want to stay, Chris, but I want to do 2 or 3 things. One, I want to answer a lot of the questions that we got.
Sure.
We answered a lot of them during our conversation, but there's more. Secondly, just if you could show them a couple more features before we forget. Do you want to click
Absolutely.
on? Do you want to click on generate? Go back to the GRAT. Go back to the GRAT, and click on generate explanation. And then you could click on GRAT 1, GRAT 2, and GRAT 3. And then you can click on PowerPoint. And then you can hit submit. So now these PowerPoints are loading up on the far right-hand side. We want to open one. Show us what it looks like. It's probably opening on another one of your screens, and you have to drag it over.
Move it over. There we go.
So this is the PowerPoint for the first GRAT, and on the second page it shows they put in 9 million. They get back payments of 4,950,000. It explains how a GRAT works, and you can do this yourself with the software. And maybe Chris, if you want to, you know, run these for everything we've done today, we can share it. And then
Sure.
it shows you what happens at the end of the GRAT term, and it gives you the information on the savings, and it even shows you the spreadsheet. So then you can adapt this to what you want to show the client. This one is without discounts, but then the next PowerPoint, when you look at it, it shows you that you put the assets in an LLC, you let it wait a while, then you transfer the 99% LLC interest, and what that looks like. So that's one feature everybody should know about. And then the other feature, if you want to go back, is you click on share with client. So here it's telling you that their code's going to be 416264. You click on generate URL, click on copy to clipboard, and now you can start an email to the client and say, Dear Clyde, I just ran this presentation for you. If you click on this and put in 416264, you can use this software and see what you think about it. And what we do in our firm is we record a little video explaining the situation to the client, and then we send the software link to their CPA, their financial advisor, and their client, and then they can play with it themselves. And some of the clients who have computer, math, or business backgrounds or law backgrounds really enjoy it. So now let's go to some questions. Let me see. Will there be a final polling question? Well, there were 4 of them, but if you didn't get all 4, just send us an email and say, well, I was there, what happened to all 4? Secondly, is estate view relevant to planning with clients in the 500,000 to $1 million range? not what we just showed you, because they don't have estate tax issues, but we do have modules that talk about life insurance value and savings, the NEST, N-E-S-T
Right. I
section.
think this is relevant, Alan.
Yeah.
And you know, answer that question. I really like sort of nest, right? Let's just say the client has $1 million of assets, and we'll do it real quick. You know, they have a $500,000 home. Sorry, they have, you know, $1 million of assets, and you know, they want to retire at 70, they're 69, and I'm not going to get too detailed in here. But you know, you could see they, hey, look, they got enough money depending on what they want to spend. So I think Nest, and I can tell you this, I think clients want answers to their questions, right? Can I buy a house? Can I retire? They don't want 30 pages of I mean, certain clients want it, but most clients want to know, could you just show me very simply, do I have enough money to retire or not? And Nest is a great way to show even multiple scenarios, and you can just keep going, and you can change some parameters and really just show them in a quick and simple format. Here, I answer your question, and the answer is yes. So
Yeah, thank you. So that, I think that would be of use. And there's other things. We also have an amortization calculator, and we have a news section that allows you to see up to 7 news feeds in the same time. So there's that. So you can see up to 7 news feeds at the same time, and we'll have tax news feeds and estate planning news feeds and stuff like that. So when you click on news, this can just be an icon on your computer, and you just have a lot more you can look at than what you get from any single news feed.
right.
Okay, Deborah says, I'm confused. This seems like a good tool, but I'm not a lawyer. I'm not sure how to start. Or do you do individuals with assets of $1 million? How do I get started? Well, Chris, there's a lot of CPAs on this webinar who don't really know how to do estate tax planning, but it's what they need to learn how to do for their best clients, and it's really darn interesting. So how would you suggest they get started?
Well, I think you get, I mean, depending on size of client, I think you get started by just, number one is playing with the software. I mean, that's how I got started, right? I pulled the software up and started playing with it and see how it works. So I would say, you know, start with a married, if you look here, like a married client, I mean, there's a lot of planning that could be done, but for clients with a couple $1 million, you keep it simple. And you just kind of work your way through and play with the software. Maybe that's not the exact answer, but I'd say the best way to get started is to get started, to learn a little more about estate planning, depending on the size of your client. Read and do research on how to plan. There's plenty of stuff out there that talks about planning for clients, you know, with 0 to 5 million or 5 to 10 million or 100 million. And as you start to learn and you jump into the software and you can start to plan. I quite frankly, Alan, think this summary, and I don't know exactly what you call it, but I call it the summary, the ability to to show the client the flow chart of how their estate runs, and you know, whether the client has you know, 109 million of assets or they have a, you know, 200,000 of assets. I still like the way it flows. Yes, when you have a few million of assets, the estate tax is not relevant, but it's still relevant so the client knows exactly how their estate flows. They may have a little bit of life insurance, and it's just a good summary.
Yeah, thank you. I hadn't thought of it that way, but it is good. I like that. Okay, another good question here is, what happens if the GRAT assets go down in value instead of up? Well, the worst case scenario is you get them all back and you haven't done any harm. But even if they go down in value a little bit, if you're able to take a reasonable discount, there may be advantage of the GRAT. And then someone else says, what's better, a GRAT or an installment sale to a grantor trust? Well, it depends on the circumstances. Almost always an installment sale to a grantor trust is going to be better, unless you're concerned with gift tax liability because of valuation issues, especially because with large families, what's left after an installment sale is all what we call GST exempt. It's never subject to estate tax at the next generation's level. With a grad, it can only benefit children, estate tax free. So that takes care of that. Chris, you see any other questions? A lot of the questions are just about what's going on, when's the next polling question. Oh, something else I'll mention is within the next month, Professor Jerry Hesch and I are going to record 3 videos for each calculator, and Chris may be on some of these videos. The first video will be, here's a layman's view of what this technique is and how it works, and a very thumbnail demonstration of the software. And I think that'll be really good for everybody. The second video we're going to do for each calculator is going to talk about how to use the calculator and solid examples that we've actually used the calculator for. The third video for each calculator is going to be a deeper dive into the tax law and the practicalities of that planning technique without using or talking about the calculator. But Chris, does that sound good to you? I think that that's probably what's most needed in the profession.
Well, I go back to the question that was asked, right? How do you get started? And I think you just answered that question. Those videos are a great way to get started, right?
Yeah.
It kind of gives you an overview of the strategy and why it's used and what it's used. And then you talk about how to use the calculator, and then you talk about the tax code. So I think you've addressed that previous question there by enhancing the software with those videos.
Right. And by the way, Professor Hesch is using the software in his LLM curriculum for estate tax planning. And if anyone here has a professor or a school in mind, any kind of school, I'm more than glad to make the software available in perpetuity for free for professors and students. Because one of the reasons that Professor Hesch and I started designing this software about 15 years ago was as an educational tool. Now,
awesome.
Judy wins 2 books. Joe, make sure we send Judy 2 books of her choice. She had a very good idea, and I saw it too, but she burns it in. We need to keep the column headers on the Excel files as one scrolls down so you can remember what the header is. And
Yes.
do you want to show them real quick, Chris, how you can show on any of these spreadsheets, you can just show every other column? So you don't have to show every column, and how you can pull the spreadsheet up. So see, he can, first of all, you can export to Excel, and then you can do whatever you want with it as a Excel document.
Yeah, I got blocked. And is this what you mean, like every other? So if you want to show 2 years, 3 years, 4 years, 5 years?
Every 4 years, every 5 years. And then you want to show how you can drag the spreadsheet up. There you see the 2 parallel lines right up tax savings. So you could drag the spreadsheet up if you want to show every line now. No, you got to go down.
Oh, sorry.
Yeah, that's all right. So now you can see more of the spreadsheet. You can drag it up. And then you want to click on the right top timelines and charts. So you can, this shows one of the red shows the assets going out, and then the gray, I think, is what's left. And then trust value over time, you want to click on that at the far right top. So that explains a little bit. So we have all kinds of little things like that in these calculators that us math nerds like to play with. Okay, Richard says, tell us again the difference between a grantor and a non-grantor clat, Chris.
The difference between a grantor and a non-grantor clat. Well, so the grantor clat is 2 things. One, when the grantor funds the clat, the grantor gets a tax deduction. And number 2, but the downside of that is the grantor has to pay the tax. The grantor has to pay the tax each year on the earnings in the clat. The non-grantor trust or clat gets funded with no tax deduction, but the clat pays the tax. It's its own separate taxpayer. but it gets a deduction for the payments made to charity. Did I hit that right, Alan?
Yeah. Yeah.
Okay.
You did.
So if you, I'll tell you what, in my experience, and Alan probably does the estate piece and administration more. A lot of times the estates would do non-grant or clat, right? If you pass money through your will or revocable trust and say, look, put everything into a clat to zero out my estate, that would be considered a non-grant or clat. In other words, the clat would be its own taxpayer, and any income it earns in a given year, it would pay tax on, but the clat, as part of the estate, would be required to make payments to charity. And then it would take deductions for those payments. So using that scenario, what's really important as you go forward is to really be managing the income tax, right? You want to make sure that in a non-grant or clat, you're managing the tax liability by how much you earn, how much you make taxable relative to how much you have to pay out every year. And the goal is you try to zero that out in a given year and pay really a little amount of tax for the clat.
Yeah.
Hopefully that answered the question.
Yeah. Chris, do you mind? Oh, I'm going to make myself the presenter now. Show my screen. See if everybody sees my screen. Hello there. Okay, so we will make the PowerPoint available to everybody. But I want to just, I can answer some of the other questions I've gotten by sharing my estate view screen here. Let me make sure I'm on it. Okay, so when you get to estate view, again, you'll put estateview.link in your browser, and then your browser will bring you to estate view. And then in estate view, you have a lot of things you can do. On the far right-hand side, you can play with the news and go ahead and pick business or news feeds. And then across the bottom, you get a live news feed, ticker tape. And these news feeds update every 30 minutes. And then for those of you who do not do estate tax work, we do now have the RMD calculator. So when I click on the far right-hand side, and oh, I'm sorry, let me light up my cursor here. Remember how to do that. Oh, we're using a CAT type software. So now you see my cursor in green. And on RMD summary, if my client is, let's say, 59, and we want to show till age 85, so we'll demonstrate 29 years, investments in the IRA growing at 7.5%, income tax rate, whatever I choose, $1 million value. This, and let me just go down here, and no charitable deduction. This now shows, and I'll pull up the spreadsheet, that the first few years, as you can see, there's no distributions needed until the client reaches age 73, and then it shows the distribution percentage, and I could show every other year just to make it easier to view, and then it shows the distribution percentage, and it shows even at age 87, they're only taking 9% out, and the million is worth $3.9 million. So it really helps show clients that these things are long-term. Now, what if the client wants to donate money every year to charity by direct qualified distribution? Bottom left-hand side, I can click on, say, 25,000, and then this shows that the net distribution would be 25,000 minus what it otherwise would have been, and it shows the tax savings by making the charitable donation. So that's just the RMD calculator. We're still improving it, but just wanted you to know that it is there. Then I'll go to married clients, and with married clients, this calculator is very, very extensive. And as Chris said, if your clients simply want to see how much they have now, what the rate of return is, what they'll have after the first death, what they'll have after the second death, then this will show them that. And you can, on the
Right.
left-hand side, the inputs are not complicated for the most part. Name, date of birth, it tells you a life expectancy, how much are they saving each year until a certain age, after that age, how much are they spending each year, will the exemption go down to half in 2026, will there be portability, what sort of inflation rate do you want to estimate, what are these assets worth, etc. And then on the right hand side, I can say, well, what happens if they both die this year with no planning? I can click on what if they die this year with planning, and what will it look like? And then if they do no planning, based upon one dying in year 9, one dying in year 20. And if I want to make quick changes to the assumptions, I can just click here. Let's say we'll let the first spouse die a little, later. Second spouse die a little later. It'll change the growth rate on the investments. Maybe they have an explosive asset that's only worth something now and is going to be worth more later. So I can show these things. And then if they do no planning for 22 years and they live out 22 years, there's their estate tax, 28 million, leaving 67 million for the descendants. And then there's a lot of different planning techniques I can use. I can click on use all of them just to show you what they are. So now I can show if you do a credit shelter trust on the first year, here's how much it'll have after the second death. Here's the additional estate tax savings. If I want to do a qualified personal residence trust, I can click on Cupert. I can do 1 Cupert or 2 Cuperts. I can do the whole house or part of the house, and it'll show me my savings from the Cuperts. It'll show me the gift tax exemption I use to do a qualified personal residence trust. If I want to do annual gifting, it'll show me annual gifting. If I want to gift discounted interest, it'll show me discounted interest. This is the new module, Chris, and this was specifically requested by a lot of people using it. A lot of people said, we don't do that many installment sales. We do a lot of large gifts.
Right.
So what will a large gift look like? So I can click on large gift on the right, and then on the left are my inputs for large gift. What's the amount I want to gift in the first year? Let's say we'll show them 7.5 million. What's my discount rate I'm using through an LLC? Let's say 3 million. So we're getting 7.5 million out of the estate. It's only considered a 5.2 million gift. Are we going to split the gift between the spouses? We could do that. And are we going to toggle off grantor trust status or let this be a grantor trust? So now I see that without the without the large gift, my gift tax, my estate tax is 21 million, and my gift trust from annual gifting has 5.8 million. Now I click on large gift. Now my estate tax is down to 15 million, and my gift trust has 27 million. So a 7.5 million gift saved a lot of estate tax. But let's say I do another million. I'll go from 7.5 million to 8.5 million. The estate tax goes from 15.9 to 15.5. So it's saving 400,000 of estate tax for every $1 million gifted. Then I can show them what happens if they change their life insurance. On the life insurance settings, I can show what policies they have now and what policies they'll have after planning, and whether these are in life insurance trusts or not now and or after planning. I click on life insurance planning, and it shows me what the situation is after they take my life insurance advice. And now you see the life insurance in yellow if it's avoiding estate tax versus purple if it's estate taxable. Then I might want to do an installment sale. So I can click on installment sale, and this takes me to the installment sale inputs on the left. And I can put in a 10% gift if I want to make sure I'm satisfying the 10% gift amount. And I can decide how much I want to sell. And so I could say, let's see here. Oh, I've got to click on my installment sale calculator, click it on, and then I can also installment sale an exploding asset, because clients say everything grows at 7% or 8%, but there may be an exploding asset. So you could put in the present value of that asset and what it's going to be after a term of years. And then you can decide what percentage to transfer of that asset into the installment sale. So before the installment sale, I'm at a $28 million tax, $1.2 million to the kids. After the installment sale, $12 million tax, $1.18 million to the kids. That's assuming that I only sell 60% of my exploding asset. If I sell 80% of my exploding asset, the estate tax is down to 11 million. If I sell 100% of my exploding asset, the estate tax is down to 8 million too. And then we go to a favorite of Chris's and mine, which is, what if instead of paying 8 million too in estate tax, we are going to give to charity? So if they give all directly to a charity, I click on charity, 100% on the left, click on charitable on the right, estate tax 0, charity gets 20 million, and the children are left with $1.012 million. Or let's say I do a CLAT, a full testamentary CLAT, 100% charitable deduction, and at the end, 50% ends up going to charity, 50% ends up going to my descendants. Now you can see that my estate tax is 0. My descendants get 112 million on the death of the surviving spouse, and 10 million 20 years later, for a total of 122 million. So we've saved a lot of estate tax there. Now there's two ways to look at all these. On each of these scenarios, you can see by trust logistics, which I have here, or across the top, I can click timeline. And the timeline shows me each trust each year. And the red part is what you're losing to the estate tax. If you just do the installment sale, for example. Before the installment sale, you're losing a lot more to estate tax. And if you do the charity, then purple is what the charity is going to receive. So all helpful. And then on this mode, I can just kill off the surviving spouse sooner or later to see what the result is based upon the year that they die. Then I can click generate client letter, and I'd like to see all the scenarios and both of the timelines and even details of the calculations. I click generate client letter, and now we wait patiently for the client letter to be. So the computer starts to talk at this juncture. It stops for a little while. By the way, this works on iPads, it works on Apple computers. It'll even work on your phone if you have a magnifying glass and you really have good dexterity. So anyway, it will also create PowerPoints of all of these slides. And it's taking its time here because it's putting all the information in, and it's writing an actual letter. Chris, anything you want to add?
No, I think you. Well, actually, yes. There's one thing. When you illustrated the charitable deed trust at death, I mean, if you look at the way you illustrated, it was basically pay 8 or 9 million to the government or give 8 or 9 million to charity. So effectively, in a lot of cases, you're using the charitable deed trust and saying, I'd rather give it to charity and let my children make that determination than giving it to the old government.
Yeah.
Right? You're going to pay somebody, so why not pay them and allow your children to control and do good versus giving it to the government?
Right. So here's the letter that we'll send all the attendees. And this letter gives you an introduction to the estate tax system. We're improving the letter, but it's not a bad letter. And then it gives you all the inputs, which can also be saved to your computer. So when you come back, you don't have to do the inputs. It tells you about all the life insurance policies and what you're doing. And then it gives you the charts as well. And of course, as I said, it also provides these for as PowerPoints that you can share with the client. So I think I've probably overstayed my welcome here, spending an extra half hour after the 1 hour presentation. Let me just see if there were any questions. I thank the people who have remained this long. Let me see. Do I think that the Corporate Transparency Act may discourage clients from placing interests into entities? Yes. By the way, we had good news November 30 on the Corporate Transparency Act that if you set up a new state registered entity in 2024, you'll have 90 days to register it with the federal government. Under the Corporate Transparency Act, by the end of 2024, every state registered entity, including all LLCs and corporations for the most part, are going to have to register their ownership and who's in control of them with the Department of Treasury. So,
Alan, quick question.
Correct.
I have a quick question on the Corporate Transparency Act. If you have an entity in effect on 12/31/2023, but shut it down in early 24, do you still have to file? Or that's
I think if you close it down, if it was formed before 2023, I mean, if it was formed before 2024 and you
Yeah.
close it down for the end of 2024, I don't think you have to register it.
got it.
Because it had until 2024 to register if it existed.
Got it.
Now, some people are saying to be safe, go ahead and terminate it before the end of 2023, but I just don't think that will be necessary.
Right. Or it's not feasible in 14 days. 15 days.
Right. Yeah.
So,
Now, David has sent us a long explanation of a planning technique that he calls the estate maximizing income trust. And I'm going to send this to you, Chris, and in our next presentation, we can talk about it.
okay, great.
It looks very interesting. George wants to know when the videos will be available. They will be done by January 8th because Heckerling starts on January 8th, and I will be at the interactive legal booth showing this to my friends and also sharing the videos. And the videos will be in the actual software. So you'll be able to go to home, and then you'll be able to go to Cupert, and then inside the general explanation will be the informational videos, and you'll be able to watch the video while you do the calculator. So you'll be able to use the calculator on two screens, one to watch the video and one to use the calculator. So again, we thank everyone for attending this presentation. I especially thank Chris Rowe. Chris, you've done a fantastic job. I want to thank you not only for this presentation, but for the previous two. We're going to make sure that all three of these presentations are posted as continuing education self-paced courses with CPA Academy. And we're going to do version 4, version 5, and version 6 as soon as we can get together for it.
Great. Well, thank you,
I hope
Alan.
everybody. All right. I hope everybody has a fantastic rest of your weekend, and we will see you again on CPA Academy, if not elsewhere. Thank you.
Thanks.
Yep. Great job, Chris.
Thank you.